Car insurance isn't one size fits all, and both extremes are expensive mistakes. Carrying only your state's bare legal minimum can leave you personally liable for six figures if you cause a serious accident. But loading up on every add-on an agent offers can waste $30 to $50 a month on coverage that barely matters. Today we're walking through exactly how to calculate the coverage you actually need using real numbers. Liability coverage is written as three numbers, like 100, 300, 100. That means $100,000 per person for bodily injury, $300,000 total per accident, and $100,000 for property damage. Here's the rule of thumb that actually matters. Your liability limit should be at least equal to your total net worth, because if you're at fault in an accident and your insurance runs out, the injured party can sue you personally for the rest: your savings, your home equity, even future wages through a garnishment in some states. If you have $150,000 in home equity and retirement savings combined, carrying only 25-50-25 minimum coverage is a real financial threat. Bumping up to 100, 300, 100 typically costs somewhere between $10 and $25 more per month, depending on your state and driving record. Cheap insurance for your entire net worth. If your assets exceed about $300,000 to $500,000, a personal umbrella policy is worth looking at. These typically provide $1 million in additional liability coverage on top of your auto and home policies for roughly $150 to $300 a year. That's often less than $25 a month for an extra $1 million of protection. It's one of the highest value per dollar products in all of insurance, and most agents never bring it up because the commission is small. Collision covers damage to your own car in an at-fault accident. Comprehensive covers non-collision events like theft, hail, or hitting a deer. Here's the math that decides whether you need these. If your car is worth $4,000 and your collision deductible is $1,000, you're really only insured for $3,000 of value, while paying maybe $40 to $60 a month for that coverage. That's $480 to $720 a year to protect $3,000. At that point, you're often better off dropping collision and comprehensive entirely and self-insuring, meaning if the car is totaled, you eat the loss and buy a replacement outright. The common guideline: once your annual premium for collision and comprehensive exceeds about 10% of your car's actual value, it's worth reconsidering. For a car worth $25,000 or more, keeping full coverage almost always makes sense. The fastest way to figure out where you're overpaying or underinsured is to actually compare quotes with your real numbers plugged in, rather than guessing. I've linked an insurance comparison tool in the description that pulls quotes from multiple carriers at once based on your vehicle, driving history, and desired coverage limits. It takes about 5 minutes and can reveal a couple $100 a year in either overpayment or dangerous gaps. Recap: set your liability limits to at least match your net worth. Consider a $1 million umbrella policy if you're above $300,000 to $500,000 in assets, since it's remarkably cheap. And reconsider collision and comprehensive once your car's value drops low enough that the premium isn't worth it anymore. Insurance isn't about buying the most or the least. It's about matching coverage to your actual financial exposure. Subscribe, because next Monday we're moving into investing with a video on 5 dividend stocks generating real monthly passive income. Comparison tool link is in the description. This video contains affiliate links, and I may earn a commission at no extra cost to you. This is not financial advice, for educational purposes only.